I bring in senior markets correspondent Kevin Green to take a look at some of the levels that he's focused on at this moment. Good morning to you, Kevin.
Good morning, Nicole. Yeah, as you kind of talked about, a little bit of weakness when you're looking at some of the sectors, but if you're looking at the price location for the S&P 500, this has been a key area of support around this level, if you will, around that 6440-ish area. So if we're looking at the levels for today, that's going to be the first one that you would expect or hope that some buyers will step in. You can look over the last couple of trading sessions here. We have been hitting this lower end of this range, buyers stepping in and then trying to push higher here. Now, what's actually very interesting is this consolidation leading into Jackson Hole on Friday. What you would like to see if you're a bull is kind of breaking above that 6485, 6500-ish area, going into Jackson Hole, and then hopefully having enough volume to sustain higher for us to really get to around 6600 here. What you do not want to see is any type of breakdown below that 6440-ish area. You're looking at 6400, and once again, you don't really want to see that from a bull standpoint. That would obviously kind of lead to a little bit of uncertainty and potentially a pullback going into a seasonally weak period for the S&P 500. So we've done a phenomenal job over the last couple of weeks here. But last week just kind of showed that we just did not have enough strength, especially when you're looking at information technology, to really push us higher. The sectors or the industries like semiconductors were relatively weak. NVIDIA wasn't really able to get out of its way around that 180-ish area. This week you want to be able to see the semiconductors as well as NVIDIA really gaining a little bit more steam here in order to hold this market up from a broader standpoint.
So I'm looking at the 10, thank you for all of that. I'm looking at the 10-year bond yield sitting at 432. This morning, we're waiting for a Jackson Hole speech later this week from Jay Powell. The likelihood of the Fed rate cut in September is at 82.9%. What are you seeing when it comes to Treasury volatility? Why is this an important conversation? What do you watch?
Yeah, so a couple of things here, Nicole. I mean, the last time that we've seen some rate cuts coming from the Fed, the market has actually front ran that, especially when you're looking at the 10-year Treasury. And are we seeing kind of the same situation happening now where the 10-year hit around 4.2% early last week before bouncing higher? But what we're looking at here is the Treasury Volatility Index, so the MOVE Index. Think of this as the VIX for Treasuries just itself. You can see that we've had this pretty decent breakdown over the last 3 years or so. This is a 3-year weekly chart, and there's an inverse relationship with Treasury volatility moving to the downside and equities moving higher. What we're looking for this week, do we actually see a bump up in that Treasury volatility index just in general here, leading up to Jackson Hole and then also going into the Fed meeting in September. But this is actually one of those indicators to make it really, really simple for those that are trading the broad-based index. Volatility, if this is a 1-year chart of that MOVE index, I just have this inversed so you can see the relationship with the S&P 500. Basically, what you want to continue to see is Treasury volatility continuing to crush. That has been conducive for equities moving higher here. Any type of reversal in that trend, especially a sustained reversal in that trend where Treasury volatility actually moves a little bit higher, that could also lead to the S&P 500 pulling back here. So a really interesting relationship, an inverse relationship between Treasury vol. But we have seen Treasury volatility actually spike up a little bit as we lead up to these major events from the Fed, which is not surprising as uncertainty around commentary is going to be key for not only equity traders but also fixed income traders here.
Okay. And then with the VIX, you're talking about volatility there with the treasuries. What about just the VIX in general? What does that mean about the fear index?
Yeah, so if we're looking at the VIX and the 15-year trend or a seasonality chart, this is the week that we usually do see volatility actually moving higher. We have had this divergence over the last couple of weeks where volatility traditionally over the last 15 years kind of stays relatively elevated, if you will, if you're looking at it on a historic basis. We don't usually see this crush and vol like we've seen over the last couple of weeks. So we're actually at a fairly lower level. This is the week where generally we do see volatility either stay or remain sticky or actually elevate here a little bit. That also coincides with VIX expiration, which is going to happen on Wednesday morning. Last trading day for the VIX options is going to be tomorrow. So be mindful of that as we might see a little bit more volatility products actually trading on the tape here today when you're looking at the options flow. A little bit more options flow on the VIX, if you will, just kind of leading up to that expiration, which could also create once again, volatility actually moving higher. So, which is actually pretty decent, right? If you have volatility going up, intraday swings are a little bit more aggressive. You just hope that they're still melting up to the upside when it comes to equities. So be mindful of this, once again, leading to the economic data that we have this week, which is a little bit light. We have some housing data, but obviously everybody's going to be focusing on what happens Friday with Jerome Powell's speech. And this also kind of aligns with that Treasury volatility that we talked about earlier, potentially creeping up, at least this week, because of that risk.
Okay. Thank you for all of that. Kevin Green, good to see you. Appreciate it.